There are several types of banks and financial institutions common in the United States. First, there are commercial banks which lend to businesses for a profit, retail banks that lend to consumers for a profit, savings and loan institutions which traditionally provided for loans for houses and saving for the purchase of a house, and once again this is for profit, and finally credit unions which provide consumer loans for its members, and this is done non-profitly. The banking system is made up of a group of companies called thrift institutions. These institutions include banks, both national and state, savings and loans, and credit unions. The banking system in the United States uses a fractional system of banking, which means that the bank does not keep all the depositors' money in the vault. The fractional banking system means that when an individual deposits money in a bank, the bank only keeps part of the money or a fraction of it. You deposit the money in the bank and the bank loans it out to other people. There are several important terms when we talk about fractional banking that you should be familiar with. First is the idea of an asset, which is money that is owed to the bank. These are loans to the general public, including businesses. Liabilities is what the bank owes its depositors or its creditors. This is the money that you put into the bank. The reserve ratio is the percent of deposits the bank is required to have on hand to be able to pay depositors when they want some of their money. There's still some more terms about financial banking that we need to look at. First off is the idea of total reserves, is the total amount of money that the bank takes in from depositors. Required reserves is the amount of money a bank is required to keep on hand to satisfy depositor demand for money. Excess reserves is the difference between total reserves minus the reserve requirement. A simple balance sheet for a bank looks something like this slide. On the left-hand side is the assets, which is what is owed to the bank, and liabilities is what the bank owes. One key point is that assets must always equal liabilities. The balance sheet in our example doesn't include things like the wages of the workers, the cost of running the bank. In addition, we won't worry about the interest paid on the loans or to the depositors. So Colleen deposits $1,000 into the bank. The law requires the bank to keep 10% of its deposit in at all times so that depositors can withdraw their money if they need it. The bank has assets of $1,000 and has liabilities of $1,000. The bank takes Colleen's deposit and divides it up into required reserve, which is 10% of the $10,000 or $100, and excess reserves, which is $900. The total must equal $1,000. What's the bank going to do with the $900 that the law does not require it to keep in its vault? The bank is going to take the excess reserves and loan them out. So when excess reserves become loans, the excess reserves become loans. Notice that the sum of the required reserves, $100, and the loans, $900, is equal to the bank's liabilities, $1,000. Joe deposits $100 in the bank, so the bank has $200 in reserves and $900 in loans. Also, notice that the bank's liabilities have increased to $1,100. The bank now has $200 in required reserve, but it's only required to keep $110 in required reserves. So the bank will keep in $110 as required by law and take $90 and convert it into a loan. So the bank now has $999 worth of loans, 90 of it which it loans to Olga. She takes the $90 loan and deposits it into another bank. The bank then divides up that deposit into what is required to keep, $9 for its required reserves, and $81 is excess reserves, which will turn into loans. In the example, if the loans that were made so far from Joe's $100 deposit, we would notice that more money is created than was originally deposited in Bank A by Joe. That is, Joe put in $100 and $90 of new money was created, and the second bank, Bank B, took 90% of that, or $81, and loaned it out. So out of that $100 deposit by Joe, $171 of new money was created by the banking system. If we follow this process through to a point where there are no more deposits, we would find that $900 was created from a single $100 deposit with a 10% reserve requirement.